The implementation of Basel I guidelines in the mid-90s and the Basel II guidelines 10 years later brought about a fair amount of consistency in the manner in which banks around the world ensure adequate capital or capital coverage to protect themselves against the many risks and the potential losses that the banking industry is fraught with. Interestingly, the global financial crisis of 2008 unearthed several facets that could not be safeguarded under the Basel II guidelines. The major reasons for those unforeseen eventualities include the following: credit intermediation outside the traditional banking system through securitization chains, hedge funds, etc. In fact, the crisis of 2008 brazenly revealed how much bigger those shadow banking channels were vis-a-vis the regulated banking system. Most of the shadow banking channels depend on the traditional regulated banking system to fulfill their payment and settlement obligations for the trades they undertake, as well as for their liquidity support. Hence, in the event of payment defaults and liquidity crunch, the traditional regulated banks end up playing the role of lender of last resort to the shadow banking system. Therefore, the fallout of the 2008 financial crisis, which was primarily a result of the exponential growth in the shadow banking system, devolved on the regulated banking system. The capital adequacy norms pursued by the regulated banking system as per the Basel II guidelines was found to be grossly inadequate to sustain and overcome the serious crises encountered post the 2008 financial meltdown. The systemic risk was further compounded by the exponential growth in structured financial instruments such as collateralized debt obligations and credit default swaps in the years immediately preceding the 2008 crisis. These instruments, in a sense, camouflage the magnitude of the overall risk being carried by the global financial system, the extent of which was uncovered only when the mark-to-market value of the assets fell rapidly and sharply, and the situation spiraled completely out of control in 2008. That in turn resulted in massive mark-to-market losses and consequent settlement defaults and a liquidity crisis which eventually devolved on the traditional banking system. That resulted in these institutions having to file for bankruptcy or having to be merged with other entities. Arising from the above scenario, the Basel Committee on Banking Supervision announced the Basel III guidelines in 2009, with implementation commencing from 2013. The highlights of Basel III guidelines is what we will see in the next few minutes. Tier 1 capital ratio, which was 4% in Basel II, has been increased to 6% in Basel III. Of that, core Tier 1 capital, comprising equity stock, which was at 2% under Basel II, has been increased to 4.5% under Basel III. Basel III guidelines further mandates that the core Tier 1 capital comprising equity stock should go up from 2% as of January 2013 to 3.5% as of January 2014 and 4.5% as of January 2019. Tier 2 capital, which could be at 4% under Basel II guidelines, has been brought down to 2%. Tier 2 capital will comprise undisclosed reserves, hybrid instruments, and provision for loan losses. As a measure of ample precaution, the concept of capital conservation buffer, COB for short, of 2.5% has been introduced in the Basel III guidelines. This reflects the amount to be held as capital over and above the minimum level of Tier 1 capital. If the COB requirement is not complied with by any bank, it cannot distribute dividends and must transfer such earnings towards COB. Furthermore, the concept of counter-cyclical buffer ranging between 0 to 2.5% additional capital is required to be set aside by banks based on the macroeconomic circumstances of the country where the bank is domiciled. CYB is to remain at 0% until 2016, when it is required to go up to 0.625% and further up to 1.25% by January 2017, 1.875% by January 2018, and 2.5% by January 2019. What are the perceived downsides to Basel III? Much of the pressure on maintaining higher capital as required under Basel III is the responsibility of the regulated banks in any country. Entities in the shadow banking system such as hedge funds and CDOs that actually created the crisis that eventually devolved on the regulated banks are not governed by the Basel III guidelines or in fact any other norm of capital adequacy. As a result, a moral hazard in the form of regulatory arbitrage by the shadow banking system is bound to aggravate. In view of the need to maintain significantly higher capital under Basel III guidelines, regulated banks are likely to find their cost of capital go up significantly, which they will be compelled to pass on to their borrowers. As a result, lending rates by banks are likely to go up once Basel III guidelines are implemented. The too big to fail syndrome will most likely aggravate, and inevitably governments will be called upon to bail out such banks. That would effectively mean, as the saying goes, capitalize the gains and socialize the losses. In simple terms, what that means is if the bank makes enormous profits, that will go to the equity shareholders, and if it makes enormous losses, the government and the taxpayers will have to bear that loss. That in turn could potentially create a serious conflict between the banking industry and the broader economy in any country. Will Basel III guidelines solve a 2008-like crisis in the future, or will it merely increase the cost of capital for banks further? The jury is still out on that question.